Today, you will learn everything you need to know about smart money concepts for trading stocks, forex, or any financial market. Breaking down smart money concepts so you can enter trades with the big players like banks and avoid losing money. When I learned this, I went from struggling to read the markets to being consistently profitable. So in today's guide, I'll cover the 6 steps you need to learn about smart money concepts, starting with what is smart money concepts? Well, smart money includes big banks, hedge funds, and institutions. They have large amounts of capital and so move the market. They also have access to advanced market data, sophisticated tools, and expert analysts. So why does this matter to everyday retail traders? Well, understanding how smart money operates allows you to trade with the big players and increases your chances of making profitable trades. Now, the next step is to understand market structure. And market structure is studying past price action to forecast future moves. Market structure has 3 main phases: uptrends, sideways markets, and downtrends. In an uptrend, price forms higher highs and higher lows, whereas in a downtrend, price forms lower highs and lower lows. However, in a sideways market, there is no clear trend. Price goes sideways, forming a consolidation. Now that you've learned about market structure, you're finally ready to learn break of structure and change of character. A break of structure is a continuation in which price forms higher highs and higher lows, or lower highs and lower lows. And in this example, price pushes up, taking out the prior high, causing a break in structure. We formed a higher high, which took out the prior higher high, causing a continuation of the existing uptrend. A change of character, on the other hand, happens when there's a trend reversal. Here, initially we had an uptrend, but then had a lower low, which took out the prior higher low, leading to a trend shift from an uptrend to a downtrend, called a change of character. And so the newly established trend is a downtrend. After the change of character, price then formed a lower high and then another lower low. This is now a break of structure, as we're continuing the newly established downtrend formed initially from the change of character. As is a continuation, we would call this a break of structure. Now let's look at something called internal and external break of structure. Break of structure and change of character are fractal nature, as they can happen on any time frame. For example, you can have an external break of structure and change of character on the daily chart, so the high time frame, as shown by this black chart. Similarly, on the 1-hour chart, you can have internal break of structures on the lower time frames, as shown by this red chart. And using this multi-time frame analysis allows for better entries and exits. Now that you've mastered market structure, understanding strong and weak price levels are important to help your trading be more profitable. A strong level comes from a move that breaks structure. For example, here we have a break of structure, as this push up took out the prior high, leading to a continuation of the uptrend. We can call this low a strong low, as this was responsible for the beginning of the move that led to a break of structure. Similarly, we had this lower low, which took out the prior higher low, leading to a change of character. And so we would call this high a strong high or a strong level, as it was responsible for a break of structure or change of character. A weak level comes from a move that fails to break structure. And in this example, we had an impulsive move down, then this lower high. As this low was not responsible for causing a move that led to a break of structure, we can call this a weak low. Weak levels, like weak lows, are less reliable and more prone to be broken. Strong levels, on the other hand, indicate zones where price is likely to reverse or react. And these concepts are crucial for the next topic, which is supply and demand. And supply and demand is really what influences price movements in any market. Simply put, price rises when demand is more than supply. Price falls when supply is less than demand. In smart money concepts, we can identify areas on the charts with imbalances between supply and demand, known as supply and demand zones. So how do we actually find the demand zone? Well, the first step is to find a strong impulsive move. And usually these are bullish candles, which are 2 to 4 times the size of the prior candles. The next step is to find the last candle before the impulsive move. Thirdly, we would draw a box around this zone from the bottom to the top wick, and this is where we would buy from for demand zones. Now the supply zone would be similar. We would find a strong impulsive move, often a bearish momentum candle, then mark the last candle before the impulsive move. We would then draw a box around the zone for the supply zone, and this is where we would consider a short position from. Price would be expected to come up to the supply zone and then reverse. So looking at this demand zone example, as you can see, price had this impulsive move up, which took out the prior high, causing a break of structure. Price then formed a demand zone at the last candle before the impulsive move. Price came back down to it, triggered in the entry for the smart money. Price reacts off the demand zone and then continues further up. Looking at the supply example, you can see we have an impulsive move, causing a change of character. The next step would be to mark the supply zone at the last candle before the impulsive move. As you can see, price then retraced to the supply zone, filling in the entry of smart money, and the price continues much lower down. And so this supply zone would have been a prime zone to short at. The next step in smart money concepts is understanding imbalances or fair value gaps, which are large movements causing temporary market inefficiencies. So an imbalance between buyers and sellers. And this can act as a magnet for price, and we can use this as potential entry points. The next step is identifying an imbalance. And so to do this, we find the strong momentum candle or subject candle as shown by this arrow. As you can see, there's a gap between the top wick of the left neighboring red candle and the bottom wick of the right neighboring candle. This is the imbalance. Often price fills in the entry by recovering this gap and then reversing. In this example, you can see we have the subject candle, but there's no gap between the top wick of the left neighboring red candle and the bottom wick of the right neighboring green candle, and therefore we have no imbalance. And so we would be less likely to look for entries in this example. In this example, you can see we have a huge impulsive move causing an imbalance. As you can see, we have the subject candle, and there is a gap between the top wick of the left neighboring candle and the bottom of the right neighboring candle. Price continues down to fill this gap and then reverses after hitting the demand zone, which just shows you how powerful these concepts are when combined together. Looking at this example, you can see we have the subject candle, and there's a gap between the neighboring candles, so we have an imbalance. This imbalance also formed near a supply zone, and so price comes back up to the supply zone to recover the gap before then continuing lower down. And so this would have been a massive short opportunity here when combined with other concepts like supply and demand. Now that you understand imbalances, the final concept that I'm going to discuss is liquidity grabs to help you trade alongside smart money and avoid getting stopped out of trades. Liquidity zones are areas with a high amount of orders and retail stop losses, and smart money may push price to trigger these orders, creating liquidity for their own orders in the opposite direction. For example, price wicks down here, taking out the stop losses of retail traders, allowing smart money to fill in their big orders, and the price reverses and then continues in the initial intended direction. This is an example of a bearish liquidity grab. Price wicks above the high, taking out the stop losses of retail traders, and then breakout traders get involved as well, but then price reverses, fueling a much bigger pullback. And so you could have got in for a short position after this liquidity grab had happened to enter with the smart money. Looking at this example, you can see there's a wick below the low, taking out the stop losses of retail traders and allowing smart money to enter the trade afterwards, leading to a reversal, and the price continues much further up. This is an example of a bullish liquidity grab. And now that you've learned about smart money concepts, if you want to become a profitable trader, you still need to learn about supply and demand. So check out my previous video in which I discussed that in more depth.